talk about, the personal side of that, the personal shift in whether that's priorities or time spent and all of that. Like, what do you think was the harder transition?
That transition from running my own company to then I, for a while, was an employee at a strategic acquirer. That was an extremely difficult transition. If you lose a customer, it's not just that you're going to get a bad performance review, but everything you spent the last 10 years building could go down to zero. So a huge amount of pressure and stress there.
It's interesting. I mean, I've been looking to acquire businesses. We recently did, not at the scale that your company had grown to.
My co-founder from the software company, he and I, we experimented with a few different things. We actually tried starting a hedge fund. We, had some other ideas for things we might want to build. Long Angle was a little bit different because that was as much a personal need.
The main question I ask every guest, and based on the name of the show being Know Your Why. So what is your why? Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Tad Fallows. Tad is a co-founder and managing director of Long Angle, a private peer community for very high net worth entrepreneurs, executives, and professionals across 45 countries. So Tad, this bio tells a lot about Long Angle, but I think it's going to sound much better coming from you. So I'll let you explain it. But first I want to say thank you for coming on the show. Thanks for taking the time out today to chat. I'm really looking forward to the conversation.
Well, thank you so much for having me here, Jason. Really excited about it as well. I enjoy listening to your podcast.
Thank you. Appreciate that.
Yeah. So if you want to hear a little bit about my story, and I probably back up one or two career steps from what I'm doing right now to how I got here, which was that after college, I went into consulting. So I worked at McKinsey for a few years. And at the end of that, thought about going on the typical step of going to business school, then getting back on the partner track there. But decided that I really wanted to, I felt like working in consulting, it was a lot of advice and strategy. And I thought business school might be more of the same. So I wanted to try getting my hands dirty and actually start a business of my own. I didn't think it would work, but I thought it would be a good experience of rolling up my sleeves and seeing what it really looked like on the operator side. And so I did that my mid-20s. We're fortunate that the company ended up being more successful than I expected. So I started that with two friends. We ran it for about 10 years, and we bootstrapped it, which meant we didn't take any venture capital, largely because of the time we started it. We started in 2006, so in 2007 or 2008, when you would normally be raising money, really the capital markets were closed, which ended up being a blessing in the long term because it forced us to have capital discipline. And so we were able to grow that to almost 100 employees. And then we sold that to a strategic acquirer about 10 years to the day from when we started. And that was a fantastic experience. Went from running a company of 3 people and you're doing everything yourselves to then running 10 people, figuring out how to manage, then 30 people and putting in place more structures. And I said, by the end, gained to almost 100. And yeah, learned a ton, and then got to a point where it made sense really to put that in the hands of a different company. And from on a professional level, that was great. On a personal level, it was a really abrupt transition then, because I went from both working 60-hour weeks and all I was doing was this company here. And at that point, I had 2 little kids and we had some very serious health issues in the family and stuff like that, to being then personally focusing my time a lot more on family stuff. And then from a kind of personal finance journey, what ended up starting Long Angle here is that I also went from having all of my net worth, or 95% of it, in this one illiquid microcap stock, to all of a sudden I got a one-time liquidity event. And so my actual liquid net worth, probably went up by 10 or 100 fold. And so then I had a bunch of new questions in terms of, okay, how do you actually responsibly manage that money? Whether it's from an investing perspective of how do you think about things like private equity or private real estate or things like that? How do you think about that money being an asset and not a liability for your kids? Mine were 1 and 4 at the time. So a lot of, thinking about how that would affect them. Things like estate planning or, tax planning, which had never really been that relevant, were all of a sudden relevant. And I felt like what led me to start Long Angle was that most of the advice for those questions was coming from somebody with a very vested interest in the answer. So, if you're asking Credit Suisse or Goldman Sachs, hey, what should I do here? they had very good advice, but I wasn't sure how much of that advice was good for them versus good for me. And so I worked with my co-founder from that software company to say, hey, let's launch a just small group of friends. Start with about a dozen other friends who are either entrepreneurs or friends who'd started hedge funds, something like that, where they'd had a large liquidity event relatively earlier in their careers, and just as kind of pure advice. We may not have all the answers, but I trust, what Jason's telling me here is just what Jason's doing, not because he's trying to sell me a life insurance policy or he's, trying to sell me wealth management services. So we started Long Angle about 5 years ago with, as I said, about a dozen of our friends. That turned out to be a lot more broadly felt need than we expected. So over the last 5 years, we've grown to over 6,000 members. All in a pretty similar demographic of generally first generation wealth creators. So that's people with roughly $5 to $100 million. We have some people on each side of that, but the bulk of people being in that 5 to 100 million range, often in their 30s and 40s, because maybe they started a company, maybe they have been working at NVIDIA or Google for the last 10 years, things like that, maybe law, crypto, real estate, medicine, et cetera. And mostly in the US, although we do have members in 45 countries now, and really as a peer-to-peer organization. So the key thing is a private online community, sort of like a private version of Facebook or Reddit or something like that, where that's free to join and free to participate, but we interview and vet every member to make sure, what they're looking for, and really the only rules being non-solicitation and confidentiality. And then over the past several years, that's really where we started. We've added a few things on top of that. One, which may be more relevant to this conversation, which is around trying to get collective access to institutional caliber alternative asset or private market investments, where most of our members say, hey, I want 80% of my money, let's say, in an S&P 500 index fund, but they want some level of exposure to whether it's venture capital, private credit, private equity, search funds, oil and gas, litigation finance, et cetera. And those, having much higher minimums and also having a much more dispersion of results. If you buy stocks randomly, you're going to get the S&P return. But if you buy hedge funds randomly, you're going to get a terrible return. So it's much more important to try and get access to the top tier ones there and basically try and take advantage of the collective power of the community, partly on a question of scale, and then partly a question of expertise, because across 6,000 people, well, then we have some people who have very deep professional expertise in each one of those submarkets, and being able to take advantage of that to kind of get best in class across those. So long story short, or maybe long story long, that's kind of my professional journey and what I'm doing now.
Yeah, no, that's a great, and I would say that's long story short, because I'm sure it wasn't quite so simple to start a company and grow it for 10 years and then have a successful exit like that. So, and congratulations on that, just phenomenal accomplishment. I'd love to, you mentioned kind of, there's the two components. There's the net worth piece of it, right? You start a company, especially like people start a company when they're young. In a lot of instances, you mentioned bootstrapping, like you probably don't have a lot of money going into it. And then you grow that company, as you said, your net worth's tied up, and then you have a large liquidity event. But also, like, that parallels what's happening in your life and time spent. And you said, now you transition, and it's like, well, now I don't have this company that I have to, kind of be focused on all the time, every day, that sort of thing. I wonder, well, I'd love to talk about that transition time, but I at first, at like a really high level, which do you think is harder? Like you built a structure to maybe address that liquidity event and people, but within the community, and maybe you do, maybe within Long Angle, you talk about, the personal side of that, the personal shift in whether that's priorities or time spent and all of that. Like, what do you think was the harder transition?
That transition from running my own company to then I, for a while, was an employee at a strategic acquirer. That was an extremely difficult transition, at least for me personally. And I did not expect that. I went in when we sold the company, I was very honest with them and said, hey, I love what I'm doing here, but really excited about joining this company because we're going from 80 employees to now we'll be part of a 20,000 person organization. I think there's so much we can do here. And then I also felt from my experience, as I said, I started my career at McKinsey, which is all about serving Fortune 500 or Fortune 100 companies, and thinking about that large corporate level strategy. I really expected to enjoy that, but but I really did not. And I think part of that, I spent a lot of time reflecting on this, because if you look from the outside, you say, okay, well, all of a sudden you go from working 60 hours a week and being responsible for making payroll. And if you don't make payroll, is it coming out of your personal bank account, or are the checks bouncing? Like, this real existential stress. If you lose a customer, it's not just that you're going to get a bad performance review, but everything you spent the last 10 years building could go down to zero. So a huge amount of pressure and stress there. And so on paper, you'd say, well, now I'm going to something where the hours are not nearly as demanding. Somebody else is responsible for legal. Somebody else is responsible for HR. And you're going to get paid much better. And, going from working 60 hours and very little salary to working very reasonable hours and a ton of salary sounds great, but it was not. I was really unhappy. And I think I didn't realize how unhappy I was until I left. I knew I was sort of unhappy, but in retrospect, that was probably the low point of my professional career. Not that it wasn't a great company. Like, I actually have a lot of respect for the company that acquired us. I don't know how much of this is a innate personality versus just life experience. But at least for me, having had the experience of running a company, and so I think there's a few things that I had trouble giving up. One was just spending the time on what I consider to be useful uses of time. So designing the product, whether that is building software or brainstorming, hey, what are the features we should have? It doesn't have to be software, it could be anything, but actually building the product or selling the product. I always thought that was fun. I was a college athlete, and the whole sales process just felt kind of like a competition. We got to figure out how to land this customer. What do they want? Who are the key decision makers? Those are really fun. The things that I do not enjoy are really just internal alignment. And it is not a knock on the company. I think it's just the nature of the beast. But if you have a company of 20 or 30,000 people, if you become more senior than that, your calendar all day is not building a product or selling a product. It's, okay, we need to get on the phone with the European field sales organization and align with them. And then we need to talk with the internal quality group. And then we need to talk with internal audit, and now regulatory, and now compliance, and now, finance. And so I would just have, 6 hours a day of meetings with no customers. It was just with other internal functions to align on stuff and to create our IT plan of record and our budget for 2 years out. And so, while it was easy, I just didn't find it satisfying. I felt like, hey, I could work really hard here, or I could barely work at all, and it's going to have no impact on the output. And I think if you just kind of look at the big picture, like, is that how I want to spend my life? It's easy, but there's no impact there. And so I think that was, and again, I don't know if it's just intrinsic personality. I'm better suited to be an entrepreneur, or having had that experience and that taste of it made that hard to go away from. So I did stay, for actually several years with the company that acquired us, partly out of, hey, I'd promised them I would do it, and so I'm going to follow through on my word. Partly out of, at least for the first couple of years, I really did think that was a career path. But then ultimately decided, hey, you know what, I'm better suited and I'm more successful at, building something myself.
Yeah. I'm sure there's a number of factors, but it's interesting. I mean, I've been looking to acquire businesses. We recently did, not at the scale that your company had grown to, but even still, like, talking to these business owners, I keep coming back to the analogy as it's almost like they're selling a child, in the sense that the amount of work and time and, like, your own molding that company has come into play really, really impacts the mindset of that seller. And so it's like, it's great.
And the team you've hired too, you feel so much loyal to these people, and like, hey, I put Sarah in this job because Sarah's excellent at this, and Heather's doing this because she's the best at that. Real sense of ownership.
They all want to protect the team. They all have their legacy tied up into it. It's like, and in a lot of instances, it's all they've known for at least a decade, if not 3 decades. Like, it's and so the mindset and, like, almost loss that probably goes into selling your life's work. That's why I've used that analogy, because I haven't sold a company myself, but I imagine, like, that is kind of the level of commitment you've had to it over time. And so I think, kind of what you experienced, I would have to imagine is normal, is kind of like a sense of loss as you transition into something else, even despite maybe you got a whole bunch of money for it. Like there's surface level, it looks like, well, great, he got an easier lifestyle and got a bunch of money and now can do whatever he wants. But I think that's not as maybe not as positive for the reasons that you just pointed to as it might look from the surface. So that's why I asked the question. How long did it take you to create Long Angle? Like what did that transition look like? I mean, you at some point realized, hey, this is not, I'm not loving this job that I've got now. But how long did it take to kind of move into this other direction?
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, so when my co-founder from the software company, he and I, we experimented with a few different things. We actually tried starting a hedge fund. We, had some other ideas for things we might want to build. Long Angle was a little bit different because that was as much a personal need of, hey, I want to build this organization. It was, I want this organization to exist because I just have these questions around, as I said, some of them were personal finance on tax and insurance. Some of them were around investing. Some of them around lifestyle of, hey, I still can't bring myself to pay for a business class ticket. Is anyone else doing that? Or, how do you talk with your kids about money? Stuff like that. And so a lot of those were just things we were thinking about, or at least personally, things I was thinking about anyway and trying to research. And so having these online conversations, and that was sort of organic in the sense of, okay, let's set up a glorified Slack channel for this group of people, and not as a professional endeavor, but really as a personal endeavor. Let's just have these conversations. And then it turned out that, okay, Jason's a member and he refers his co-founder, Mike, and then Mike refers this guy on the board or his brother or something like that, where we found most of our members, they don't have a big enough personal network of people in the same situation to be able to have these conversations. They typically have 2 or 3 friends with whom they can really have open conversations about money. But then we found, okay, well, each of them are inviting their 2 or 3 friends. And so it ends up being that this community grows well outside of the people I knew personally. When you're at 6,000 or 7,000 people, it's 4th or 5th or 6th degree of connection. But it was really when that started to happen. And I would say I've observed there's some other groups like this. Like if you look at, for example, maybe early Google employees or early Facebook employees or something like that, where you'll have a set of people who all, for some reason, collectively had a significant net worth event. Those groups often form organically. And then when you get around 100 to 200 people, it kind of becomes this thing where it can't self-organize anymore. If you want this group to sustain itself, you have to have somebody who actually rolls up their sleeve and says, okay, I'm going to treat this like my job. And I'm going to do, say, moderation of the channel, because once you get to a couple hundred people, there's going to be some bad actor who's trying to use this as a place to gain investment or to gain clients. I'm going to do, work on the infrastructure, because if we just do it as a Slack channel, it's just going to become overwhelming. So we need a different app to support this. I'm going to work on, maybe, as I mentioned, with these investments, or, people are collectively saying, hey, it would be cool if we could negotiate discounts with some, service provider. Somebody's got to step up and do it. So we found we got to 100 to 200 people that felt like, okay, this group is going well, but it's only going to keep going well if we actually jump in and treat this more seriously and don't just participate in the discussions, but really, work on it full time to kind of build out an organization around it. So that was probably a year or 2 in when we said, okay, this is something that's worth really, focusing on and building. And I think that ended up being fortuitous timing of both of us saying, hey, it's not working out to continue to work at the acquirer here. We are looking to do something else with our time. And here's this thing that seems to have momentum and would be a good use of time. And maybe it'll turn into a business or not. But at a minimum, we're kind of supporting these conversations. We're finding a lot of personal value in.
Yeah. I hadn't really thought about the example you used of like a, Google exit event type of thing or liquidity event where people organically form the groups. And I mean, it makes a lot of sense because having money is a good problem to have, but it does create some of the things that you mentioned where you're like, well, how do I handle this from a tax perspective? How do I handle this from a legacy perspective and estate and trust structures and all of that? And like the other one that I always like, this is the big thing. Like I always ask guests if they have kids about, okay, well, how do you talk to your kids about it? How do you create a environment in your home where it's like, a lot of people who have money now maybe didn't come from money. And so they learned about money sort of the hard way. And, and then you have kids that are in an environment where you want to provide for them. You want them to live a good life, but also don't want them to be spoiled and blow it all. There's a whole lot of consideration as to, how to talk to them, how to show them, life and things like that. So I'd love to get your take on that particular topic, but just having a group with which to discuss things like that and that are experientially based, not like you said, like a, someone who's trying to sell you insurance. It's like, of course they're going to tell you like, this is the insurance you should have. And then many of us have found out the hard way that probably wasn't the insurance we should have. And like, you figure these things out. So what did you, I'd love to hear what you think about, how to handle this message with kids if you take that.
No, it's certainly something I've thought about a lot. As I mentioned, my kids were, I think, 1 and 4 when I sold the company. So it ended up being great timing, both because it allowed me to be a very present dad for their early years. As I mentioned, we also had some other health things going on, but, very present there. And I think at that point, still very formative. I think by 1 year old, you've neither spoiled your kid nor put them in the right direction. You're, just starting that journey. Even at 4, that's probably the case. Yeah. So I have, and I would say if there is a single question that across all 6,000 or 7,000 members of our community is the number one question, it is this. It is, how do I raise kids with wealth? Not everyone has kids, but 80% of them probably do. And yeah, there's a certain point to which, okay, let's say you've got 20 or $30 million. You're not actually going to run out of money. Even if you go speculating on Bitcoin and you go, flying first class all the time and stuff like that, it is very unlikely you're going to run out of money, but it is very possible to ruin your kids or not raise the kids the way that you wanted to. And I think one thing a lot of the members discover is, especially if they have a very abrupt liquidity event where, okay, on one day I went from having nothing to having $10 million, it doesn't change as much as you think. Like if you have a good relationship with your kids, you're still going to have a good one. But if you have a bad relationship with your children, suddenly just pouring a bunch of money on the situation does not fix that. Same way, if you're unhealthy beforehand, you don't suddenly, get a six pack just because you have money. So it doesn't fix all of these things. So in terms of, very specifically on the how do you talk with kids about a few things. One is I feel pretty high conviction in saying that not talking with them is not a good answer for a few reasons. One is just on principle, honesty is a good policy, and, a lie by omission of just this never coming up is not a good thing. And that's it, especially because maybe if you could keep it secret forever, that's fine, but you're not going to. And so then what you're messaging to your kids, hey, this is an awkward topic. This is something to not be comfortable with. This is something not to be discussed. And so then, I think there's some probably apocryphal stories about, somebody Googling their dad. And that's when they found out that their dad has $100 million because they see that, he sold a hedge fund or something like that. And then that kid realized, okay, my parents are lying to me. This is an awkward topic. And then also you're not there to help them. You may not have all the answers, but the worst thing is just tell your kids, hey, figure out yourself how to think about money and what does it mean? If you want to be sending those messages, which presumably most parents do, that, hey, having more money doesn't make you a better person. It doesn't mean that you're off the hook to contribute back to society. It doesn't mean you don't have to work hard. You want to actually have that conversation and not just leave them, to themselves to sort of try and sort that stuff out. So I do think that having the conversation, and of course, as anyone say, it should be an age appropriate way. But I actually don't, now having had kids through a number of years with this, I don't think it's particularly difficult to have age appropriate conversations. So, as an example, with our kids, we don't give them a ton of presents at, Christmas or birthdays, but give them some. And one thing I do for everyone is we give them one share of stock in something. And so, I'll have conversations with them about, okay, well, when they're real little, maybe that's one or two. It's just, hey, here's a Disney certificate. And you see it's got these cool characters on it. And that's all it is. As they get a little bit older, my daughter really was interested in Sephora. And so, okay, got her a Sephora share of stock. But then when they get older than that, you can actually start talking about price to earnings ratio and growth rates and that sort of thing. And, kind of have the back and forth. And some of them can end up tending to be very meaningful conversations where, my son's a big growth investor, so he always wants to buy more, NVIDIA and Microsoft and stuff. And I always tell him it's overvalued, and he always ends up being right. That keeps going up. But then I was, trying to pitch him. I was saying, hey, Philip Morris, if you bought that 100 years ago, you would have gotten something like 120 million% return on Philip Morris. And so I was really, laying out the virtue of a value stock. And then he looks at me and says, but Daddy, cigarettes hurt people. And so, I think that felt like a great parent and a terrible human when he, pointed out the flaw in this argument. But I think that point of actually just kind of having these conversations. So it can be things about investing like that. Or if it's just, for example, as he got older into, started talking about budgeting. And I found it useful rather than using imaginary numbers of like, he was asking about how you buy a house. And his comment was like, well, of course, no house could cost $1 million. And I laid out, well, no, actually, houses do cost this much. And like, here's what average salaries are, and just sharing those actual numbers. I don't think you're really protecting your kids from anything by pretending it's all monopoly money or the numbers aren't real. So sharing some of that. So anyway, I do think speaking openly about it. I also, I've done a lot of not first-person research, but reading books by other people who have done that first-person research into children of wealth who end up being successful. One I would give a shout out to is there's a woman named Covey Pitt Edwards who wrote a book called, I believe, Raised Healthy, Wealthy, and Wise. And what she did is she works for a big wealth manager. So, fair disclosure that that's the background she's coming from. But what she did is she studied something like a couple hundred kids who grew up with very significant wealth and were, quote, successful, which I think she was defining successful not as, hey, they made a ton of money themselves, but the things you would want. Like they were in happy, stable marriages. They had kids of their own. They had some sort of productive job. Maybe it didn't make a lot of money, but they were productive members of society. They were not addicted. So the kinds of things any of us would want for our kids. And looking at the commonalities there. And beyond this idea of having open exposure to them, another one that I found very interesting and was that those children had all had early in their lives totally supported themselves. Even if they were coming from a billionaire family where that was totally unnecessary, for at least a few years, they had been completely off the family payroll. And that helped them in basically this sort of sense of confidence, because apparently one of the things that you worry about is somebody then gets this fear. If you as Jason grew up without money and then you made $10 million, you'd be sad to lose it, but you wouldn't have this dread of like, oh my God, what am I going to do? I'm going to be on the street if I lose it. You feel like, well, I could roll up my sleeves and start again. And I'll be annoyed, but I'm capable of doing that. Whereas if you grew up with 100 million that, grandpa or great grandpa made, you may feel this sort of, hey, if that money runs out, I have no idea what to do with myself. So it gives people this kind of sense of stability of, no, it would suck, but I could move on and I'm capable of supporting myself. So I thought that was a very interesting one. The other thing that stuck out at me from a number of this research is I think this fear of the kids becoming drug addicts and going through 6 marriages and that sort of thing is a bit overblown. It does happen, but it is not the standard case. Most people have good values, raise their kids with good values. Their kids go on to, maybe they work in the family business, maybe they get a normal job somewhere else, maybe they stay home and raise kids. But most kids don't turn out this way. It's not like you're fighting the odds. That if you kind of do your best and have, put a reasonable effort in, your kids will probably be fine.
Yeah, no, that's great. And the idea of them, having at least a period of time to sort of build their own thing, where, kind of support themselves. It makes a lot of sense. And you're right. Like I worry about providing for my family, but I don't. It wouldn't be hard for me to not have money again. Like I did that. I know what I know what to do there. I know how to get out of that situation. It raises the stakes when you have family, but like you're absolutely right. It's like that. the experience of understanding like you're going to be okay, you'll get through it, and this is what you do to get out of that. Giving them that experience is actually, I hadn't really heard that described that way before, but I like it. One of the other things that I've heard from another guest on the podcast was basically, anything that his kids want, he says, I'll be in for half. And so if they want something, expect, like if you look at a car, they're like, okay, you can buy this used Toyota for $10,000 and I'll pay $5,000. Or if you need to have the Maserati, you've got to come up with the other, $70,000. So like just kind of teaching them, it's like, I don't think it would feel good to have large monetary success and not share it with my family and my kids in some way. But it's like, how do you balance that? And it seemed like a very simple but effective way. And I think combining it with what you described as far as like, they do need to have some opportunities to just like know how to take care of themselves and build something for themselves. I think it is a tremendously important and good point. Just like these little simple things probably make answering that question a whole lot easier.
And to build on what you're saying, that 50% share made me think another thing I try and do with my kids is structure their financial life as much like a adult financial life as I can. And what I mean by that is, they get an allowance and it's not much. It's maybe $5 a week, something like that. But I actually went with each of them to the bank, set up a checking account, and I direct deposit their allowance. Because I'm thinking, that's how every paycheck I've ever gotten is always direct deposit. You're not getting cash, so it's direct deposit there, and they get their bank statement in the mail once a month and they can read it through. And then I also, as you're saying with the matching, is I say, hey, you can buy whatever you want with this. It's your money. So, if you want to blow it on Reese's, you can buy Reese's. If you want to buy toys, you can do that. But if you invest it, I will dollar for dollar match the investment. And again, that looks a lot like a 401k sort of or IRA matching. And so, they've ended up actually investing a large majority because they sort of do the math and say, wow, well, I can buy, all these stocks half off. So they end up investing it. Or I say, if you give it to charity, I'll match dollar for dollar on the charity. And so I think that, which again, looks sort of like a government tax benefit there. So it's very much simplified, and the same thing also, if they want to, let's say they want to invest and buy a share of Microsoft, I actually set them up little brokerage accounts on Fidelity. And so I will have them be the one who actually pushes the buttons. They say, okay, buy one share, and they type in the symbol and they set in their limit price and they actually click buy on it, which I think a lot of that is just around demystifying it. It doesn't become this, I don't, I vaguely know this exists, but hey, I've actually done it. It's not hard to buy a share. It's not hard to sell a share. I've seen the money show up in my bank account, and and actually what they love is the dividends. My son's like, hey, I got I got $3 this week and I didn't do anything for it. I just sat there and got $3. It's going to happen again next quarter, and they have to give me a raise. And so I think even though it starts with small dollars, you really get the passion. And actually that, $5 a week plus occasional stocks at birthdays and Christmas is now, I don't know, a $15,000 portfolio. So it also shows that power of compounding of what seemed like just trivial numbers along the way add up to real money at the end. And so if he does want to buy a car or something, he actually, has the money for that. So I put in a strong plug for that.
Yeah, no, I love that. I love that concept. And I mean, the best thing, like to me, the most powerful tool in investing, regardless of asset class, is time, right? So like if your kids are doing it at 5 or 10, or they've got so much more time for that growth to happen, and understanding that and like instilling this process with them. It's like it might be $5 a week now, but eventually they're going to get a job, and then they might put $100 a week in there, like and it's going to grow even faster. And so when they start to see those things be demonstrated in real life, as you said, like treating it like an adult financial picture, especially because so much of finance now is effectively virtual, right? Like hardly do you ever get a paper paycheck. Nobody hands cash back and forth it's all like on a phone, or you're ordering things on Amazon, or like what. And so, I mean, my kids, we tell them a lot. Like, sure, we might go on the phone and say, buy this whatever coloring book or this puzzle or whatever, but money comes from our account to pay for that. And so I think like letting them see those things and understand the reality of like yes, it is happening virtually or digitally, but it's real money that we have to then go work and make and all of that. So I think, I love those ideas. Within Long Angle, you've got a 6,000 member group. You just talked a lot about kind of the messaging and questions that come around raising children. What else? I know I think I saw in the bio a real maybe focus on alternative investing or alternative assets. Like how much of that is again it's a discussion is my understanding, is people just saying like, hey, I do this, so oh, that sounds interesting, I'd like to know more about it, kind of thing. Or how do you, when you made that transition to having it be more of a formal thing, is there more formality to the discussion, or how does it look now?
I would say some of it is just, hey, what do you do? And let's share advice on it. And then there's a short list of tactical things where we say, hey, we actually could do this collectively better. So in terms of the what do you do, example there might be something like taxes. I would say one thing that comes up a lot is everybody feels like the one sucker who's actually paying their taxes. And so if it makes your listeners feel better, I would say you're not the one sucker. If real estate, I think, is its own special thing, and real estate people, for good or bad reasons, have developed a tax code that's extremely favorable to them. But almost everything else outside real estate, there's no real way to get around it. If you make a lot of money, you're going to pay a lot of taxes. And that's just kind of, I think Oliver Wendell Holmes says the cost of living in a civilized society. So, there's occasionally people will bring up these absurd tax schemes that somebody pushed on them. Like, okay, well, I'm going to buy a bunch of, cantaloupe seeds and freeze them for 13 months and then donate them to Haiti. And then I'm going to tell the IRS they're worth 10 times what I paid for them and that sort of thing. And I think those tend not to end well. The IRS is on to most of the, conservation easements everybody knows are fake now, but there's all these other things which the promoter will go great lengths to tell you how it's not the same as a conservation easement, even though it all involves, some phantom markup on a property. So anyway, there's things like that, like taxes, where people just discuss, hey, do you know a good CPA, or what are you doing for this strategy, things like that. But then, as I said, there's some where we actually feel like there's collective power in the community. And so one of those is alternative assets. And so I think private equity being probably the biggest sub-asset class there, so maybe a good example of it, where we will 1 to 2 times a month, we will identify some compelling private market opportunity, and we will set up basically a feeder fund where anybody in the community has the opportunity to participate in that and make the investment. And the advantage of that are basically twofold. One is, if you talk about what I'll call an institution quality alternative or institutional quality investment, and what I mean by institutional quality is that you are investing alongside like the Stanford Endowment or the Duke Endowment or the California Pension Fund. You're not investing alongside a bunch of, maybe I'm a doctor or dentist and I'm investing alongside a bunch of other doctors and dentists. Right. If you invest alongside these institutions, you tend to get better track records, much better fee terms. That's probably the biggest difference, is somebody who is targeting the so-called retail investor, that, the doctors and dentists, is just going to charge much higher fees in general, which really eat into the returns. But to get into those institutional funds, you need two things. One is there's often a $10 or $15 million minimum there. And so very few of us, even let's say you have $10 million, you're certainly not going to put 100% of it into a single vintage of a single private equity fund. You'll maybe want to put in 100,000. And so we'll set up a feeder fund where we'll have 200 members each put in 100,000. So we're able to hit a $20 million cumulative investment, but everybody's investing, within an amount that makes sense for them. And then there's also basically the diligence and the relationship aspects, which are related but different things. The relationship could be a lot of your very high performing funds just won't take anybody's money, even if you can write the $20 million check. They want to make sure that you're the kind of investor they want, that you're sophisticated, that you will actually meet your capital call obligations, that you're looking for a long-term relationship and you'll be in for multiple funds, these different things like that, where you basically have to develop those relationships and credibility over time. And then also the diligence and the underwriting, where the very nature of public markets is that you have this public regulation like the SEC, who makes sure that there is full, clear information. There's just a whole lot of frameworks which are very good and create a lot of investor protections which don't exist in private markets. And so the downside, both the upside and the downside of that is those don't exist. The upside means if you do a good job diligencing them and finding the right opportunity, you can get outsized returns that are greater than what's available in the public market. But the downside is that it's like they say with a poker game, if you don't know who the sucker at the table is, it's probably you. If you don't really, understand what's happening, you're probably the one that's going into the wrong fund there. And so we also have a team of people who basically, who we've hired in from JP Morgan or other places, that do this sort of thing full time to help diligence. And, I don't care whether, again, it's oil and gas or private credit or any of the above. There's basically good and bad versions of those. And if you look at the, venture capital will be the extreme example, where the top quartile venture capital funds return 20 or 30% a year, and the bottom quartile lose money. And so trying to, separate the wheat from the chaff there is critical.
Yeah. No, I mean, it sounds like a very, valuable community for a number of reasons, right? As you mentioned, the financial, the cumulative financial power to go in and get invested in some of these assets, but also just the cumulative knowledge and experience and wisdom of people that have built businesses, had significant events happen that maybe change the way that we would look at our lives. So I think it's phenomenal, and it's invitation only is my understanding, correct? That there's
not invitation only. People have to apply. So as I said, we don't charge a membership fee, but we do have an interview with every potential member. If anybody's interested who's listening, if you just go to our website, longangle.com, there's an apply button. And all that means it's like a 30-second form, but it sets you up for a phone call with a current member. And, we're not looking for a particular persona. Like, we're not saying, hey, you have to be the most sophisticated investor in X, Y, or Z. Really, the core thing we're doing there is trying to screen out people who are coming to share knowledge and to learn versus those who are coming to get a check from another member, because it just becomes too tempting for somebody who's like a life insurance salesman or a wealth manager of saying, hey, this is a pocket of people who I can sell to. And so that's really the key thing we're doing there, is making sure that we understand people's motivations to come. And we tell them just directly, if you are looking to get a check from another member, please don't join. It's not a fit for you. We're going to remove you. You're going to be unhappy. But if you want to learn and you want to share, we'd love to have you. And then, the more diversity, the better, whether that's different professional backgrounds or ages or, geographies, things like that.
Fantastic. Well, Tad, let me switch gears. I want to make sure I have time to ask you the main question I ask every guest, and based on the name of the show being Know Your Why. So what is your why? You've had, a successful, started a business, successful exit. Now you've built this community. What's keeping you motivated and excited about the future? What is your why?
Yeah, it's a great question. And I will admit, I probably don't know it as well as some of your guests might. I haven't had the sort of big, philosophical epiphany about it. Although, maybe that in itself is just kind of coming to terms with that is my why. But I'd say it's a couple folds. One is, and I bet 99% of people who have kids feel this way, but I hadn't realized before having kids how much that would become so important to me. And I do think one thing I've really appreciated is the ability, as they've been kids, to not just work, but do things like, okay, I'm going to be, a scoutmaster in the scout troop, and I'm going to be a, assistant coach on the softball team, or honestly, I really enjoy driving the kids around to activities. I know that feels like the kind of thing that you could totally outsource, and I'm in favor of a lot of outsourcing. I outsource all of my gardening. I, don't clean. I do the dishes, but, outsource the kind of deep cleaning of the house. But actually driving the kids around is one of the things I like the most, because I feel like they talk in a way that if you just, especially my son, if I sit down with him and ask him like, well, tell me who you played with at recess and about your day, he's going to totally clam up. But when you're just driving 45 minutes to go to some tennis tournament, it all kind of comes out in more of a natural friendship there. And also even just like fun listening to different podcasts, you get into things together. So my daughter and I are listening to a History of Rome podcast and stuff like that, and just having those connections. So, why, like, the most unoriginal statement ever, but, for the kids and for the family. And then on the professional side, I would say, I think it's as simple as I've just realized I really enjoy kind of building businesses and building organizations. I think that's what I learned of saying, okay, I built my own thing, and then I tried working in middle management at an acquirer. and I just really enjoy the act of building it. So, I like board games. In some ways, it's like that, where it's just kind of this strategy, and it's engaging and fun. You get to work with people that you like. You get to test these problems and see what works and what doesn't. So honestly, there's just a level of I enjoy it. Could I prove it's the best use for society of my time? I don't know. I don't think, I believe what we're doing is helping a lot of people who I want to be helping, but I do think a big part of it is that it's fun.
Yeah. That's but by the way, there's no wrong answers on that, on that question. I don't think there's, maybe some people have an epiphany, but I have always felt it's, especially for me and just for talking to people on this, most of the time there's some evolution to it. It sometimes changes depending on what life cycle, your life stage you're in. And also I don't know, now I have this podcast, so I think about it. It's like, I can look back years and be like, well, I had a very different why when I was 20 than I do now. So it's kind of like, I think it's just even my thought process around it has evolved. So, well, this has been great. I've really enjoyed this conversation. When people hear this and they want to connect, what's the best way for them to reach out?
Yeah. Either find me on LinkedIn. I'm pretty active there. It's Tad Fallows. Or as I said, if they're interested in Long Angle, if you just go to our website, longangle.com, and hit apply there. Those are probably the two best ways to contact further.
Perfect. We'll have those in the show notes so people can find you easily. Tad, thank you so much for coming on the show today. Thanks for the discussion. I really enjoyed it. I really enjoyed kind of what you shared. Talking about how to be a better parent is always a passion of mine. So I appreciate you indulging me on that question. But yeah, thanks for taking the time. I really do truly appreciate it.
Well, this is great, Jason, and thanks for putting on the podcast. I enjoy listening to it.
Folks listening, make sure you connect with Tad. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you so much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?